thank you for inviting me. I think it's definitely going to be, I think we could probably do a lot more of these, and I think a lot of people are going to benefit from it. So just a little bit about myself. I'm from the Caribbean originally. I ended up moving to the US when I was 18 years old and joined the Air Force and did 4 years, active duty military. And then I decided to get out. I did my last deployment in 2012. I decided to get out and go to school for business administration. And then I got offered a position at a nonprofit, CDFI, which is a community development financial institution in Raleigh, doing SBA community advantage loans, or their SBA 7-day community advantage loans, which go up to $250,000. And so I started working at that organization as a loan processor, basically taking in all the documents that came into the organization. And since we only did SBA loans, these were documentation only specific to SBA. And because the bank has to basically modify their guidelines to meet SBA guidelines in order for them to get that SBA guarantee. That's why a lot of banks do the SBA loans, because they get either the 75 or 85, and in this case, because of the CARES Act, they get the 90% guarantee, saying that if the loan ever defaults, that the U.S. government through the SBA administration is going to guarantee that they will pay back up to 90% of the loan if they did the loan according to SBA guidelines. And so that's kind of how I got my start in SBA lending. So I did loan processing for probably about 6 months, and I ended up doing a credit analysis role for about a year, and then I did an underwriting role for about 4 years. And then I ended up going to Wells Fargo, which was super, super corporate, a little bit too corporate for me. And so I ended up getting a role under the board of directors from the CDFI. Found out that, I had got a job at Wells Fargo and was like, hey man, do you want to work with Harvest? All we do is owner occupied commercial real estate lending through SBA. Hey, LaDonna. And do you want to work with Harvest as a business development associate for us? And so that's kind of how I got into this role. And I kind of fell in love with the SBA because of the mission. And so the mission, the SBA was established in 1953 by Dwight D. Eisenhower as part of the Small Business Act. And the reason for that is there's 3 major reasons for developing that. Is to, one, help establish and maintain the free markets, the free enterprise. I took a couple notes, so if you don't mind me take a look at it. So assist and protect the interests of small businesses and concerns, preserve the free competitive enterprise that we have here in the U.S., and maintain and strengthen the overall economy as a whole. And I didn't really understand the need for the SBA until I actually had an individual from the SBA come in, and she talked about the actual history of the SBA, right? And so I'm a history guy, and I like to kind of know the reason why I'm doing things, because I'm like, I don't know about you, but nobody likes to do things and just not know why. So, and the reason for that is, if we look at the stats, so I pull up a couple stats in preparation of coming here. So it says 99.7% of U.S. employer firms are small businesses. So you have the Googles, you have the Apples, you got all these Amazons. Yeah, they employ a ton of employees, but the majority of the U.S. jobs come from small businesses. And that's why the Small Business Administration was founded, is to protect that. Because if something were to happen to our small businesses, Amazon and Apple or any of these businesses, they're great companies, they're not going to be able to keep our small businesses alive. Our economy alive. It's going to be those small, mom and pop shops, and the SBA describes small businesses having 500 or less employees. That's what they consider to be a small business. And so it's going to be the bakery down the shop that employs 2 people, or the barber shop that employs about 5 barbers. That's what's going to keep the economy going and the money coming through the business. Through the economy. And so that's why it's so important. That's why I believe the SBA is so important, because whenever there's a disaster like we're having right now with the coronavirus, the SBA comes in and helps provide that income or those funds to keep these businesses going. Because if not for that, you're going to be losing millions and millions of jobs that could then have an adverse effect on the U.S. economy as a whole. And so that's why I believe it's so important. So there are multiple ways that the SBA does this. So there's four major ways. One is access to capital, providing small business owners with the capital they need to either start or maintain their businesses. And the reason why that's so important, and I didn't realize this as I continue my growth in my career in lending and in the SBA, is that a major bank like Wells Fargo is not going to give money to a startup company. They're not going to give money to an individual who has, doesn't have $1 million in the bank, or, their business is not pulling in $1 million in revenue. So that's why the SBA is there, is to do that, is to kind of provide capital to those individuals who are just starting out. They have the potential to make $1 million a year in revenue or net profit, but they're not there yet, And so the second thing is to provide entrepreneurial development. The SBA has 1,800 locations where you can go in as an entrepreneur, an existing or a new entrepreneur, and get counseling on how to write a business plan, how to do a profit and loss statement, how to do a balance sheet, how to do projections, all of these different skills that entrepreneur needs to have. The SBA has, like I said, 1,800 locations across the US that you can just go in for free and get this done. Of course, you have to set up an appointment and stuff like that. There's a little bit of wait, but then you can sit down and get that done. And we send, when I used to work at the CDC, we used to send small business owners to the SBA reps in our area to help them build those projections and to find out those numbers that you're plugging into those projections. Where are these numbers coming from? If you're having costs, if you're a baker and you have cost of goods sold, of $20,000 annually, can you break that down to a lender so a lender can say, oh, that makes sense. I'll lend you some money because of this business plan, And so sometimes you see a lot of times that people are either the best baker in the world, the best barber in the world, but you have to learn the other part of it, which is the business acumen side of it. And the SBA does that. So that's the second thing they do. First thing is access to capital. The second thing is entrepreneurial development. The third thing is government contracting. And so what the SBA does, the SBA says for any other government agency that's out there, their combined prime contract dollars, 23% of that has to go to small businesses. So they're saying they're going to other, Department of Transportation or Department of Human Services. If you have contracts that are going out, as a whole, every government agency has to put aside 23% of those funds for small businesses. So that's the third thing. That's how the SBA helps small businesses. The fourth thing is advocacy. So if there's any kind of legislation going on in Congress, as far as CARES Act, or what they're planning to do with the economy, what they're planning to do like military wise, or the SBA sits in those meetings, and it says, well, this is how this is going to affect the small business owners of America, right? So you're going to be doing this and you're going to be doing that, but are you thinking about what kind of impact that's going to have on small businesses across the US? So those are like the four ways that the SBA helps to protect small businesses and help them grow, And just a little bit about the CARES Act. That's kind of just my little history on the SBA, right reason why it was founded, what they're there to do, and how they actually get that done. What I'm going to talk about now is a little bit about the CARES Act. So the CARES Act is the Coronavirus Aid, Relief, and Economic Securities Act. And the main reason for this is, we all know what happened through, the pandemic, right? You had massive loss of jobs, millions and billions of businesses closing down. And so the SBA has not only incentivized business owners by providing them with that 3-month relief up to $9,000 a month and providing and waiving the SBA guarantee fee, but they're also telling the banks that if you decide to lend money to a small business owner, right, we're going to guarantee up to, instead of 85 or 75% of your loan that you give to a borrower, we're going to guarantee up to 90% of that. So if this loan was to ever default, we'll give you 90% of the loan back. As long as you underwrite your loans according to SBA guidelines, we're gonna guarantee 90% of that loan. And how they incentivize small business owners is that, there's an SBA guarantee fee that has to be paid for every SBA loan that's done. And the reason for this is that the SBA is a $28 billion. It takes $28 billion to run the SBA on an annual basis, everything that they do. And that's zero subsidy. And that's us all paid through either SBA fees that are paid by the borrower when they apply for an SBA loan, or any lender that does SBA lending has to pay fees to the SBA. And that's how they keep the SBA alive. It's a minimum, I think it's up to $100 million out of the $28 billion, 100 million of that is taxpayer money. And if you're looking at any other like government agency that's out there, that's nothing compared to what they're spending on getting their job done. So the SBA pays for itself. It's a bipartisan. It's like nobody usually goes after the SBA because, they're the small business agency, so they should be able to balance their money, their budget, and be able to pay for themselves. That's what I'm guessing, right? So they don't really take a lot of money from taxpayers, and they handle their business in house. And so going back to where we're talking about the CARES Act, that fee, that guarantee fee. So I'm just do a quick calculation right here. So we've got let's say a $4 million loan, right? $4 million loan. You're looking at a 75% guarantee fee on that. So you take the $4 million times 0.75. You're looking at the SBA is going to guarantee up to $3 million of that $4 million loan. And then the borrower pays 3% of that. So times 0.30, that's $90,000. That's $90,000 that the borrower could have paid, but because of the CARES Act, they don't have to pay that anymore because of the CARES Act. So that's $90,000 that's going towards you hiring a new employee, or you hiring a sales team, or you hiring, that's the return on your investment. That $90,000 could be turned into $200,000 or $300,000 in revenue, so that means a lot to a small business. 90 grand means a lot to a small business. The second thing is that the SBA waives the first 3 months of payments. So actually, the SBA actually pays your first 3 months of payment. They don't waive it. They pay it themselves to the bank, up to $9,000. And as part of the CARES Act, that the lender themselves, they can actually decide to defer more of those payments. So it can go up to 6 months or 9 months. But because of the CARES Act, the SBA will allow them to defer those payments without penalizing. And the reason I say penalize is because if there's ever a time where a borrower goes into default on a loan, or where they're not making their payments, that could cause the lender to lose their SBA guarantee. And so the SBA says, we're going to make the first 3 months of payments up to $9,000 a month, but we're also going to allow you to defer any payments to your borrower because we understand that this is a tough time, right? And another good thing about having an SBA loan is that major banks, they don't really care what's going on in the economy, right? If you don't meet your loan covenants, if you're not meeting what, every February or March, anybody who has a business loan with a bank has to turn in their financials to the bank, so the bank's able to look at how they're doing in their business. So, if you file your 2020 returns, you got to turn your 2020 returns to the banks. Most banks have covenants, which is what they require business owners to provide if they have a loan with that bank. So if you have an SBA loan, the SBA doesn't require you. And what happens is, if you're outside of covenants, they could decide to pull the loan, or call the loan forward, or require a balloon payment on the loan. So the bank can say, hey, you're outside of covenants. You're supposed to be in this revenue mark, or you're supposed to be doing this. You're not doing it, and you're actually putting our portfolio at risk. And the bank's portfolio is what determines how strong the bank is, and when they want to get funding from either the federal government to relend that money, or funding from larger banks. For example, the CDFI I used to work for in Raleigh, North Carolina, they would get funding from Wells Fargo based on their portfolio, which is basically their credit report. And if a bank, if say I'm going for a funding from Wells Fargo in order at 3% in order for me to lend at 6%, the bank's going to look at my portfolio and say, well, you've got about 15 to 20% of your loans are currently in default, right? And so how banks get around that is that they actually, if there are loans on balance on their portfolio that's in default or that are outside of covenants and are going towards default, they will either call that loan in full, like say, hey, we want you to pay off your whole $1.5 million loan, or they're going to that's basically what they're going to do. There's no or. That's basically what they're going to do. They're going to say like, hey, you're in default. This is going to make our ratios look bad and affect us getting funding in the future for our operations. So we're going to pull this loan forward. And the reason that's going back to, if you don't have $1 million in the bank, you're not making $1 million in profit. If you're doing that, if you got $1 million and millions of dollars in the bank and you're making $1 million in profit, you can pay that loan in full when they say, hey, we want you to pay this loan in full, right? So it's all about mitigating the risk when it comes to bank. They already know they're not going to give a loan to you if you don't have $1 million in the bank or you're making $1 million in revenue. But because of the fact that you do, and if they need to call a loan, you can pay it, then they'll give it to you because the bank is in the risk business, And so when you get go ahead. I'm sorry, guys. Yes.
I'd like to ask a question before we go too much with, into outer space with all this. I need to talk about what I'm dealing with right now, right?
Yeah, so sure. Yeah.
My question is, thanks for, helping me with this loan that we're working on. But my question is, I have a donut shop, right? I have an owner. She is wanting to rent a space and she knows she has to put in $100,000 in tenant improvements. She has been having her donut truck for 10 years. Now she's going to be going, into a brick and mortar. What loan can she get? Because what I'm hearing, or what I heard, was the SBA 7A that we were talking about had a minimum of 250,000. But in this case, looking at 100,000, is there any of that? She has the cash, she's got it ready, but I'm telling her maybe she can get a loan instead of spending all her own money.
Yeah, and so there's an SBA 7A Community Advantage loan program that does loans under 250,000. Now, any bank that deals with the SBA, they can do a loan under 250,000. It just depends on what bank you go to. So for my bank, Harvest, we have a minimum of 250,000. That's the lowest we'll go because it's literally the same amount of documentation for doing a small loan than it does for doing a big loan. So at the end of the day, with our bank, it's about running a business. So you have X amount in overhead. If you do this small loan, you're going to get minimum return on your investment. You're probably going to be losing stuff like that. So that's why you have these small community banks like a CDC or a CDFI, and they do the community advantage lending, which is I think 2,500 to 250,000 around that loan amount.
Okay, so how would she find those? Like you mentioned, SCORE, that's the name of those business people that you meet with. Would she start there, or can she just go online and find one in her area or the area where her places of business going to be?
Yeah, I would just say go online and look for a local CDFI or a local CDC in the area, and they will be able to definitely help her to get that done. And yeah, they could definitely do that. Sure.
Okay.
And
then
go ahead.
Go ahead. I was just going to say on what we were talking about, like your example of the 4 million, just to let Ginny know in particular, we're talking about an a 51% occupied, owner occupied business building real estate. So in other words, Ginny, you can use this to buy real estate. Your clients can use this to buy real estate as long as they're 51% occupied into that building. Can you talk a little bit about that, Akem?
Yeah. So basically what the SBA is, what they're trying to avoid is this to turn into a program for investment properties. And so what they're saying is that they want you, and also what it does when you occupy the space that you're operating out of, it incentivize a borrower to actually make their payments on time because you're actually working out of that space. It's more like a psychological thing, I think, as well. But what it is you, as long as you occupy 50.1% of the space, this is considered an owner occupied real estate, and the SBA will finance that. So it's not going to be considered investment property or anything like that, and the SBA will finance it. And so you can also have, it could be a mixed use. So you can occupy 50.1% of the space, and it can have some rental units up top, or it can be all commercial, and you have 50.1 of the space that your business is occupying and operating out of, and you have other business owners that occupy the remainder of the space as tenants.
And how much is the percentage of interest rate normally? How does that, is there points? How much is normally the interest rate?
So usually it's based off prime. So prime right now is 3.25, and for Harvest it's usually prime plus 2.75, but it differs for every lender that's out there. So I think this is based on whatever lender you go to, that's going to be their rate. But the rate is also based off risk as well. So the riskier the loan, the higher the rate, because the bank's trying to recoup that investment as fast as they can because of the risk.
So in this case, that would be 6%, but is there any points on top of that, origination fees, or no? It's just a flat.
It's just a flat rate. It's just a flat rate for Harvest. For me, it's for our organizations. I don't know what other lenders are doing, but it's for us, it's that 6%. And then there's a $2,500 like processing fee that's on there as well.
Okay, that's good to know, because y'all do commercial loans in that regard. That's a good deal. I usually tell people, 6 to 8%, maybe 2 points, just to get them to really realize and do the math and be prepared in case.
Oh, are you talking about points to brokers or just points in general, or to?
Well, yeah, whatever. If you have a commercial building and you want to get a loan on it, and you want to have your client go to somebody to get a loan, that's what I usually quote them, just to be safe. 6 to 8%, 2 points.
That's 6 for us. Is going to be 6 for us. Is going to be 6%. That's the highest we're going to go on that.
Okay, sounds good. Does anybody else have any questions? You look fabulous, LaDonna.
Thank you. That was such an amazing breakdown, Akem. That was awesome.
And I talk a lot when I'm nervous, so that's probably what's going on right now.
Okay, LaDonna, can talk and see if we can hear you. There you go.